Good morning, and thanks for joining us here on Condo Solutions. Monday mornings from 9 to 10 o'clock, we talk about condos and homeowners associations and the occasional co-op and the occasional timeshare. So we're glad you joined us. If you haven't, you're not hearing any of this, so it doesn't make any difference. But we're here for you. We're here to help you out. We've been doing this for a long time. Mainly, we thought we were helping, but it may just be because we have nothing better to do on a Monday morning. But for those of you that do have something better to do on a Monday morning, we're trying to make it interesting and significant. So let me give you a little background for those that are new to the show. Those that have been listening for a while already know all this, so they can turn the radio off for a while or whatever. But we've been doing this for about 17 or 18 years. My name is Mark Brackbill. I'm a CPA. I'm a licensed community association manager. And along with me doing the show for that same period of time is Peter Mullengarden. Peter is an attorney who specializes in the area of CIRA, which is Common Interest Realty Associations. That is the whole group, CIRA law, and has been doing that for a number of years. So you've got a very, very experienced attorney that's available on the phone for absolutely no charge. And we're here to kind of answer some of the questions that go on. Maybe you're a board member and you have some board questions, something, about how to handle an issue from a board standpoint. Maybe you're a unit owner. You're not sure how they can do this or why they should do that or what they should do. Maybe you're just curious about it. Maybe you're thinking about living in a homeowners association or condo association in Florida. And that is a significant possibility if you're moving to Florida. So we're here to just answer some of those questions. You might be new to Florida and not familiar with it. And we do have a really, I think, a pretty good set of laws in Florida, not too intrusive, but they are more restrictive than a lot of states because we have a lot of condo associations and we have a lot of homeowners associations. And you take on some responsibility when you move into one of those associations in Florida, and you give up some rights when you move into one of those associations in Florida. So it's important to understand all of that. And that's why we're here for that. And that's what the kind of thing that we provide and try to provide to you and have been for a long, long time. Our number in the studio is 772 220 9788. That's 772-220-WSTU is the number in the studio in case you want to call. A couple things on calling in. You don't have to give us your name. You just have to give us a name. You don't have to give us your association. In fact, we probably prefer not to have that information because it causes some issues for other listeners who think maybe your question doesn't apply, potentially for Peter or I, because you may be a client. Anyway, or a potential client or become a client. So, so that's kind of the basics there. We do tend to answer your question specifically, but we try to also answer it from a broad standpoint because our goal is to maybe hit some of those other issues that are out there that maybe is not exactly the same as a caller's question, but it might be close. So those are really the basic ground rules. The only other thing that we caution about is that we give the best answer we possibly can, but we do not have your documents. And without your documents, we cannot give you a hard and fast legal answer. In fact, even with your documents, sometimes we don't know because the courts may decide something different. So we do try to give you the best answer we can without your documents. So we'll rely on your interpretation of your documents and your common practices, maybe court cases and things like that are typical. But if you're looking for an answer that you may have to go to court with, especially a board member or things like that, you really should contact somebody like Peter, who's a specialist in this area, and have him answer your questions. So anyway, that's the basic ground rules. Good morning, Peter.
Morning, Mark. How are you?
Good. We have a caller this morning, so I'm gonna get to him right away, but I just wanted to say hi and I hope you had a good weekend and everything went good.
Yeah, well, thank you. It's Monday.
Yeah, I know. That's right. It's Monday, and it's getting closer to everybody going to school, all those kind of things. So it's all traffic's going to pick back up again, all those. But
It's all good.
yeah, Edna, go ahead. Are you there?
Yes.
Thanks for calling
Please.
in.
Good morning.
Morning.
Please go over what needs to be posted on the website if it's not addressed in your documents.
Posted on our website for you mean for meetings or things like those notices?
Yeah, on the condo website.
Okay. All right. For meeting notices. Peter, you want to go ahead and touch on that?
No, your documents have to be posted. The meeting notices have to be posted. Any documents that are going to be considered at a meeting have to be posted. The financial report and the budget need to be posted. If you're going to be considering the budget at a meeting, that has to be posted. So those are the things that need to be posted. Also on the website, I have to go back by my memory now. I believe it's executory contracts. No, that's not true actually. I have to double check that. But that's top of my head. I have to double check on the other stuff. On top of my head.
What about bids?
Bids?
I believe the bids also, yes, they have to be posted as well.
The Edna, on I assume that you have a large enough association that you're required to have a website.
Yes, it's over 150 units.
Yeah. So that's one of the things that.
Yeah, the bids are on there too. Go ahead, Mark.
Okay. No, I was just making a point that some association, that the requirement for websites, we've talked about this before. I'm not a big fan of websites because of the fact that most condo and HOAs, but most condos, which are governed by that, don't have the kind of computer technology strength to be able to prevent someone from hacking your information. And frankly, with what's going on out there today, I really believe that this law, this is just an opinion on my part, I do believe this law requiring these websites was a mistake and really needs to be rolled back because
Edna, here's the list. I'm gonna interrupt Mark.
Yeah, go ahead. No, go ahead.
But I was just trying to do it by memory, and so it's your declaration, your bylaws, your articles, your rules, and all the amendments to those documents. A list of all the executory contracts or documents to which association is a party, or which the owners have an obligation. A list of bids received by the association within the past year. You can also have a summary of bids for anything that costs more than $500 must be maintained on the website for at least 1 year. And in lieu of summaries, you can have the actual bids, the annual budget, as I mentioned, any proposed budget coming up for the next year. If your association is going to be considering that at the annual meeting, which is not typical, by the way. Usually you don't consider the budget at an annual meeting, but it is on the list. The financial report, which is what I mentioned. Each director's certification, which I omitted. So each director is required to be certified. So that means either the educational certificate or the actual certification that they sign, whatever they've submitted for that. Any contracts between the association and any director or officer that's not affiliated with the association or any other entity. Any conflict of interest document, that's not going to be too often. As I mentioned before, the notice of any owner meeting and the agenda for that meeting, at least 14 days in advance, must be on there. You have to also post, as I mentioned, any document that is going to be considered and voted on by the owners at a meeting. Notice of any board meeting, the agenda, and any other document required for that board meeting. I know that was kind of quick, but that's the list.
Now, Peter, if I got a quick question on that. So let's say you're 100 units, and so you weren't required to have a website, but you have one. Is this applicable if you have a website, no matter whether you're required to or not, or only if you're required to have a website?
I believe it's only for those that have to have the website.
Okay.
Okay. I think if you're not under the mandate, then you're somewhat free to do what you want with your website.
Okay. That's that. I just was wanting to clarify that. And also financial reports. I've noticed when I go to websites for associations that they never have their most recent set of audited or reviewed financial statements or compiled financial statements if they're required to. They may have a budget, they may have their internal financial statements from the property management company, but hardly ever find the actual financials. And you know, they're supposed to be available when you buy a unit. But they're all it ever says is, you know, financial report, and a lot of people get confused and think that that's just the, you know, the budget or whatever else. Can you speak to that? What you know, in terms of financial report, what exactly do should they have there?
Well, as you mentioned, I mean, every association's financial report depends upon, you know, various factors, mostly their income, you know, for the preceding year, and whether or not they've waived the budget, you know, to go up or down in terms of down from an audit or down from a review. So, you know, what they're required is the financial report, which is required by the statute, and any monthly income or expense statements to be considered at a meeting is what has to be on there. So if you're considering things at a meeting, but the financial report is, you know, what is the financial report? What's their most current report that they were required to do?
Right. Okay.
Either pursuant to their documents, because the documents may require a higher level of reporting, or pursuant to the statute. And as you know, depending on your annual revenue, then you're in either the audit category, the review category, the compilation category, or the report of receipts and expenditures.
Right. All right. And then also there should be you know, I think Peter mentioned this, but there should be a copy of the you should have a copy of the most recent reserve schedule, and some information relative to the reserves. That's supposed
Well, that would be in your budget, though.
Well,
Okay,
it would be in your budget. It would be in your financial report, technically. But I know a lot of people are looking for that information right now, and so I'm just kind of clarifying the different places that it could be. So,
although not to interrupt, although the annual budget, if that's interesting, because on the reserve schedule, yes, that the whatever level of reserves that you're budgeting must be, you know, in that budget. But if you're waiving reserves every year, or if you're voting for some kind of lesser amount, then the proposed budget that's sent to the owners must show the full reserve schedule before you vote. But your actual budget that gets approved, you know, obviously if they waive it, or if they vote for reduced reserves, is not going to show that. But you don't have to have on your website that fully reserved budget that you sent out to the owners before they voted. I know that sounds confusing, but what I'm saying is the website is the actual budget with the actual reserve schedule. But just to remind everybody that before associations vote, if they do vote on waiver or on partial funding, they need to show the owners before they do that vote what the full reserve schedule would be. But if you're doing that full reserve schedule, if it gets waived or gets partially funded, does not have to be posted.
mm-hmm. Yeah.
But it would have to be posted. Excuse me, not making this full circle. It would have to be posted, though, on the website before the meeting that you're voting on it. So,
right.
So there is a posting there, but how long it stays depends.
Yeah. So
I know that's kind of confusing, but
All right. When you're talking about financial reports, I have yet to find an accountant who gets it done within the 90-day time frame from when I hope I'm right on this, but when the books are turned over to the accountant.
No, it's actually
by the end of the fiscal year.
It's actually 90 days from the end of the fiscal year, and you basically have another 21 days or so after that. So
yeah, it's really 120 days.
Yeah, so typically it's 120 days. It's you know, the end of April if you're a 12/31 year end. Now that's interesting. You mentioned that because there are a couple things that again, depending upon your documents say, but the timetable for those financial statements are it's you know, as we said, it's about 120 days, and it is difficult sometimes to get those done in that time frame, and follow all of our professional guidelines. And some firms like to confirm balances with banks and things like that. That can take 45 days. And as you
Yes,
pointed
there's
out,
a lot of back and forth that
Right,
goes on
right.
many times.
right, and as you pointed out, Ed, it would be nice if it was from the time that we get their books closed, that we get a set of books that are closed and bank reconciliations. But in associations' defense, in many cases, they can't balance the bank account and get everything closed out for at least 20 or 30 days themselves. So a lot of times we lose a whole month at the beginning. We don't get any of the stuff to start doing the work until February. But what I've done in the past, and again, it depends on what your documents say. There are a number of firms in the state of Florida, but not an unlimited number, that specialize in condos and HOAs. We do a ton of that type of work. And when I'm talking about that, I mean 20, 30, 40, 100 associations. I've got one friend in our industry that he's done over 6,000 turnover audits. So I mean, there's guys that do a lot of this kind of work. And truthfully, if I owned this, those are the people I want to do this work. I don't want somebody that doesn't know anything about the industry, doesn't know the laws, because the laws affect a lot of things. They affect a lot of accounting transactions in this area. And so you get somebody who's kind of a newcomer to it. It's, you don't want somebody who's only done one or two or is doing 5 a year or something, because the industry's complicated, it changes, and and it is very specific. So but it's, unless you're going to be paying a ridiculously high amount of money, everybody in the world is trying to get their audits done by April 30th, because you've got,
Right.
you got a lot of them are 12/31 year ends. So one of the things that I did with my clients or offered is, as Peter mentioned, you can waive typically or reduce. You can't waive completely, but you can reduce. So I can reduce an audit to a review, or I can reduce an audit to a financial report, a statement of receipts and expenditures. I can reduce a review to that. I can reduce a compilation to that. And so what I've done
But that also depends on the size of the budget. If you're over a certain amount, then you have to have a yearly audit.
No, you can waive that. You can waive
And?
it. You can reduce it. You cannot waive it completely. You can't say we're not doing anything, but you can reduce that reporting requirement from an audit to a report of revenues revenues and expenditures, basically.
Unless your documents require you to do the higher level.
Right. And so that's one thing that you can look at. So now sometimes documents will say, frankly, it's the same as with attorneys in this area as it is with accountants in this area. You want an attorney in this area, especially one that's doing your documents, to actually understand condo law and understand the specifics and what's involved here. I've seen documents that refer to an audit, but that's not what they mean, because they're talking about getting together a group from the board and having them look at the books, and that's not an audit. An audit, a financial statement audit, has to be done by an independent certified public accountant. And so many times there is language about that. Well, we have to have an audit by February or whatever. So that and what they mean is an internal review. It may not be the same thing. So you have to check with your attorney to see what the language actually is going to be interpreted as or really means. But as Peter said, if your documents are basically just say that in accordance with Florida statute, then you have the option, first of all, of reducing from an audit to whatever level you want. And you also have an opportunity to potentially change the time that it's due. So let's say that you want to do an audit, but you don't want to pay the in-season prices, right? But you want a good firm. You want somebody that's doing that kind of stuff. So what you do is you have the
Change your fiscal year.
well, that I know that's a solution, and a lot of people talk about that, but frankly, sometimes that doesn't work as well because I'm a practical guy, and it works good for me as a CPA preparing a set of financials, but it may not work well for board administration, elections, doing the budget for the next year, those kind of things. A lot of times, board members want to do a budget after they've seen the audited financial statements from the previous year to make sure that the numbers didn't change on them or something. So I agree that's a possibility, Peter. But if you can, a simple method is to take a vote and vote to reduce your level of reporting from, let's say, an audit to a report of receipts and disbursements, which does not have to be done by a CPA, and then simultaneously vote to have an audit done in the off season to take advantage of a discount of some kind, 20%, 10%, whatever. We offer a 20% discount if you do it out of season. So then that's just because we don't have to pay overtime. It's a very practical answer. We can use the same people, very experienced people, but we don't have to have them working Saturdays and Sundays and all nights and weekends. And we've got more time to review the work and make sure everything gets done correctly. So that's an alternative. And we have a lot of clients that do that. So as a result, we have a number of, off-season type things. I will tell you one thing about that, which is interesting. Because of our requirements as CPAs, having your work done in, let's say, June or July, that let's say we're getting your report out at that period of time instead of April. That's kind of nice because many people have gone up north, right?
Mm-hmm.
And as CPAs, we have to report about subsequent events, major contracts that have been started, things like that, any kind of actions, lawsuits, whatever. We have to report about any of those activities in the footnotes up to the date of that we release the report. So say July. And so for that reason, a person up north can actually see what's happened after they left. They've got that project did start, or it didn't start, or it got delayed, or whatever the deal was. So a lot of times that, as long as you get it at the same time every year, so it's every July, you're actually getting the same kind of information, but you're getting a little bit more each time because of that stub period that we have to provide that we have some responsibility for, which we call subsequent review. So anyway, that's just something for people to give some consideration to, because it is a way to use a firm that maybe is an experienced firm and still get a good price. I'll jump off my soapbox in a minute here, but I was going to mention this just so that board members know the cost of financial statements are going to be going up. And there's two reasons for it. One, there are fewer and fewer auditors, fewer and fewer people that have audit experience. They may have tax experience. They may have some other accounting experience, but they don't have audit experience. And so it's harder and harder to get those. And it's harder and harder for smaller firms, which are the more affordable ones, to be able to get those people. So that's one thing. The other thing is that our professional people, the AICPA, FASB, and to some degree the Florida Institute of Certified Public Accountants, they tend to think if you're an auditor, if you're doing audit work, that you're auditing General Motors or Apple or something. I mean, that you can afford to do and should do all of the things that you do for an audit of that company, which is extremely expensive. And it doesn't improve the quality of the audit. It just increases the documentation that's required. And that documentation for most of our clients, including our condo and HOA clients, is kind of a waste because it doesn't add anything to the audit. We can't rely on it. So what's happening is the AICPA right now, through their peer review program, is going to require that a CPA firm that does audit work have a single person devoted to nothing but going back, not going back, nothing but going and reviewing jobs that have already been finished. These aren't the jobs that are in process, because we already have a person under our field standards. We have to have a qualified person to review the work papers and make sure the work is being done correctly. But you're also going to have a person that does nothing but go back in after all of those jobs are done and check those jobs again. That is extremely expensive. You can't put a new staff person on that. You're talking about a person that you're probably paying $90,000 to $100,000 a year, and now you've got to cover that cost, and it's not really part of the job, so you're going to have to cover it from everybody. So these are the kind of things that are happening in the audit area right now that are really they concern me, because it's going to make it more and more difficult for associations to get smaller firms to be able to do some of this work. And we're the ones that, McGladrey and Price Waterhouse, and they don't care about condo audits. They won't even bid on a condo audit. They won't give you a price. They don't want that kind of work. When our last revenue recognition guideline came in, we asked the Big Four to provide guidance as to what they thought. Only 2 answered. The other 2 said, we don't care. We don't do any of that stuff. I mean, that's actually what they said. We don't do any of that, so we don't care. And the other 2 said, we don't do it for other than some big timeshares, but here's what we think. So anyway, just kind of a little bit of a side note as to what's going on and how you may be able to reduce some of your costs right now. And you need to keep an eye on what's going on with costs going forward. So anyway.
All right. Thank you.
You're welcome, Edna. Thank you for the call. That was a good call. Appreciate it. Peter, I was going to mention that this morning, so I'm glad Edna gave us a lead in on this, but there's a couple things going on this morning I was going to mention. One is I talked to a friend of mine who is on the National Peer Review Committee. In fact, he's dropping off now and getting rid of his audit practice, frankly. So here's a guy that did enough audit work that he was actually on the AICPA audit. He was the small firm representative on the peer review committee. And these are the guys that review, that review audits of CPA firms, basically. And he's leaving because he said, you're not going to be able to afford the cost. Another thing that's coming out of the accounting profession, there's a lot of garbage coming out of the accounting profession right now. It all started with 606, the revenue recognition, which has confused the heck out of people. And that's confused everybody relative to reserves. And now, so that's confused everything relative to reserves. And now we got all these reserve issues that are starting to pop up relative to Champlain and Champlain, or I guess that's how you say it, right? Champlain?
Champlain Towers.
Champlain Towers, yeah. So you got that coming up. And now, like I said, you got this peer review thing. So there's a lot of pressure on our industry as it relates to accounting. One of the things that CPAs have skirted, I mentioned to Edna that you have to be independent. Yeah, not only does it have to be done by a CPA, but it has to be done by an independent CPA. And most people think of independence as, well, you don't live in the association. Well, you can actually live in the association and still be independent. But, most people think of things like that. I own the business, or I'm on the board. Let's use that example, that I'm auditing an association where I'm on the board of the association. I can't do that. So, at that point, that's what they think of as independence. But in reality, the biggest independence problem with associations is that their accounting personnel and their board don't understand accounting enough to be able to tell whether or not, when we come in and propose an adjustment or require you to disclose something or make a change, to know whether or not that's correct, right? Because if you don't have the expertise to be able to say, no, that's not correct, or no, this needs to be disclosed this way, or no, that adjustment's not right, then if you don't have that kind of expertise, then we're making that decision and we become part of management. And so then we're not independent. Well, think about it. How many condo associations and HOAs have a bookkeeper who has enough of an accounting background, or a board member even that has enough of an accounting background to evaluate whether or not we've implemented our ASU 606 on revenue recognition contracts with customers correctly? Nobody, right? Do you know if we've implemented the new leasing standard correctly? No. So we have to educate you so that hopefully once you're educated, you will know. But there again, we're educating you. So this is a big problem for our industry, and it's not a problem for the big firms. They don't, the clients they audit, they have people that know this stuff, probably better than the auditors sometimes, but because they deal in just a specific industry. So this isn't a problem for the big firms. This isn't the problem for the big companies. This is a problem for condos and HOAs. So it's going to be a more difficult. I think the state's going to have to address it at some point as well, because it's going to get to the point that it's going to be a problem. One of the other things I was going to mention is that we have was two things I'm going to mention. One has to do with turnovers, but we have with the whole aspect of revenues, as you mentioned, Peter. Whether you have to have an audit, whether you have to have a review, is based on revenues. Well, the new audit standard for revenue recognition just took a bunch of revenue and deferred it. So you may have paid an assessment, and your assessments may have been, $700,000, and they collected $700,000. But maybe $400,000 was going to your reserves. All right. Well, that's no longer revenue the way a lot of CPAs are interpreting it. That's now deferred revenue. So it's not revenue. So the only time that becomes revenue is if you actually do the work associated with that money. So if you did $400,000 worth of work, it might be revenue. So now here's the problem that associations have to consider. And I don't know if this has come up for you yet, Peter, or not, but do I have to have an audit? Let's take the example I'm talking about, and I have $700,000 in total revenues, total collections, total assessments, right? Not revenues, total assessments. And $400,000 of that or $450,000 of that was going into my reserves. Well, the way some CPAs are interpreting this the way most CPAs are interpreting this new standard, that $450,000 is not revenue. It goes into a deferred revenue into your balance sheet as a liability, and it is not income. So you just went from income revenue of $700,000 to revenue of $250,000. So now all of a sudden you've changed your reporting requirement. You're not required to have an audit. You're not required to have a review. You've dropped all the way down to a compilation.
So now we have to go to an accountant to get an opinion regarding how much revenue we have to determine whether we need what type of report we need.
Right. And actually, that's the independence thing I'm talking about. You actually can't go to us and ask us. You're supposed to already know. You're supposed to have read that statute or read that opinion. I mean, that's standard, and you're supposed to know how to apply it.
So we have to go to two different accountants?
Yeah, potentially. So
you go to one accountant to figure out whether you need the report, and then the other accountant to do it.
Yeah.
So that's where we are?
I mean, you could, yeah. You could
you can't go to the same guy, right? Because it's not independent, like you said.
Well,
or the same person. Shouldn't say guy.
Yeah. Technically, what you could do is sit down with the statute. The standard. It's only 400 pages or so,
There you go.
and go through it with the board and make sure they understand. You can go through it with your property management company maybe and make sure that they can give guidance. But no, it's an issue, and we've winked at this, Peter. We've winked at this problem for years. We've always winked at the problem that they don't really have an accounting person. We are their chief financial officer because they don't have anybody that really fully understands. Even if they've got a CPA on the board, if you don't practice in this area, you don't understand all of the intricacies of what's going on, especially relative to revenue recognition and other things. So it's a big issue for people that they're just ignoring right now, but it's not going to be ignored for a long time. We're not going to be able to keep ignoring it. Here's the other thing that happens. Let's say that let's say my reserve assessments are $200,000 a year. I mean, not my reserve assessment. My total assessments are $200,000 a year. And let's say I'm putting 50,000 of that into the reserves, or maybe 20. Let's say we're putting 20 in the reserves. So my income is maybe $180,000 under the new standard. So I don't have to do anything, right? But here's what's interesting. Let's say at the end of the year, come November or so, I decide to start on the balcony job that I've been putting money aside for 20 years now for balcony, and I've got $400,000 or $500,000 in my balcony reserve account. And now I start the construction, right? So I bring in that expense, that $400,000 worth of expense, but I also bring in revenue that's been sitting out there and deferred. It's not this year's revenue. It was revenue from the last 20 years, and I bring it in right now. And so now my revenue goes up to $600,000 or whatever. Well, now I had to have an audit. So when are you going to know that? Never, maybe, because you weren't even required to have, let's say, a compilation. So nobody looks at it and knows that, oh man, under 606, we should have had an audit. And the state currently follows follows GAAP, follows US GAAP. So technically, you could find out at the end of the year that you should have had an audit instead of a review. You could have already potentially been into the middle of the review, and it's during the review that the person finds out that, oh, your revenues are above this level. You should have had an audit, and you didn't properly waive it. So that is what is out there right now. It's really kind of crazy, but it's and it's all as a result. And here, and the last thing, and it goes to your question or your comment, Peter. This new standard is what's called a principles-based standard, which means that it's not rules-based. They don't tell you, here, go to this book, read this, here's the rule, make sure it's applied. That's not what it is. It's principles-based, which means that you read it, look at what are the guidelines, the principles that they establish for recognition, and then determine whether they meet those, how you think they meet them, if it applies or doesn't apply, and how it should be interpreted. And then you, as the CPA, determine whether or not they've interpreted it correctly. So you could have multiple professionals, that CPA that you get to come in to make an interpretation of how it should be handled. The person that comes in to do your review or your audit could have a completely different approach to it. And that person is not wrong, and the person that told you is not wrong. They just have a different approach, so they come up with a different answer, and that both those answers are right as long as they're documented. Both of them are right. So that's the other problem you've got, is that even if you get professionals involved, the person that's actually doing your audit may have a different way of applying it than the person that that did it, or that did it last year, if you've changed auditors. So that's another thing that's going to come into play, is when you change auditors, you're really going to have to ask some questions as to what that auditor's position is on revenue recognition. So that's kind of out there right now. It hasn't come up yet because it's only been 1 year. This is the year that some of these firms are starting to deal with it, and some of these associations are going to start seeing all of a sudden their fund balance went from 4 million to zero, and there's something on their balance sheet called contract liabilities that they have no idea what that is. So the other thing I mentioned or ask you, Peter. So you said on the website you've got to report your contract liabilities, right?
But your contracts.
Your contracts. So I assume if it's considered a contract with the unit owners that we're going to apply a certain amount of money is being set aside for roof replacement and whatever, that all would have to be there. So even if even on the reserve side, even furthermore, there's some issues there as to whether or not there needs to be some other disclosure of that, because right now a reserve schedule would show nothing, because there is nothing in your fund balance for reserves. It's all on the liabilities. It's all on the balance sheet. So anyway, so that's just some things that I wanted to mention. One other thing I was going to mention, Peter, because it just came to my attention, and this is for associations out there that are still under developer control. And I'm sure it's something that probably we will talk about later, maybe a little bit, although we don't get into a lot of developer stuff. But there's been some disagreement between for some period of time on when developers are responsible for reserves, and this is in the HOA area. In the condo area, it's kind of been fairly clear. There's some definitions and all of that, but in the HOA area, it hasn't been quite as clear. And but even in the condo area, the establishment of statutory reserves when they're actually established was still somewhat questionable. But again, like I say, in the HOA area, it was very, very questionable. And we had a case out of the 5th District called McKenzie versus Lennar, I think is what it was. Anyway, and that threw everything into a tizzy, because basically that court, probably incorrectly, said that if a developer puts any money aside for reserves, even if they put it in their operating budget, that they're now responsible for the reserves. Now, McKenzie was a very fact-based situation. They actually started to fund reserves and then decided not to and took the money out. So a lot of attorneys in the developer area were saying that didn't apply. It doesn't apply to the regular statute, but it has resulted in a lot of litigation, and it's resulted in a lot of settlements as a result of that litigation, where developers have had to pay associations money because they were concerned that they would be deemed to have established reserves and then have to pay a lot more money. The other question that comes up, if you have established reserves, are you then responsible to fund them correctly? And if you waive or don't fully fund, now do you have a responsibility after the fact, after you've turned over, to go back and fully fund those reserves? And some developers were concerned enough with McKenzie that they've settled 6 and 7 figure settlements because of concerns about that. So the state legislature, I think it's Senate Bill 630, which was signed by the governor, so it's effective, and it says in effect that a developer can't establish reserves by anything other than by putting it in their documents and requiring it in their documents, or by the members after turnover, basically voting to establish reserves. It's the only way they can establish reserves. They can't start funding it. They can't arbitrarily fund it. There's no way under this statute. Now, normally that would be for any association or any developer approval starting with July 1st of this year. Usually it'd be going. They made it retroactive. So it applies to any association that currently exists, whether they're currently under developer turnover or whether they were previously under developer turnover. They basically have made it retroactive. So if you're in a situation where this is an issue because you may be subject to developer turnover, you may feel like the developer underfunded reserves and should have funded reserves. This is going to be a tough situation because this thing got slipped in. Frankly, it got slipped into the legislation at literally the last hour. It went in a bill. It had been sitting out there for years. Nobody ever, for a couple of years, never gotten filed, and all of a sudden it got filed and attached, and it's gotten signed. And I know a lot of associations had potentially tried to file lawsuits as of June 30th, so that they could argue that they were, that they were grandfathered in. But it's going to be much harder for associations to challenge these reserves now with this new law, because we actually have legislation. So anyway, I just want to throw that out there. We do have some associations that may potentially be under developer control. There's associations out in Tradition and some of those places. I know, Peter, you probably know of some associations that are just turned over or are turning over. So it's an issue, and it's now going to create, it's basically, until that is changed, until Senate Bill 630 is changed, it's going to put a permanent statutory, non-statutory reserves in, especially on the HOA side. It's going to create this permanent, this permanent situation potentially, which means that because there is no requirement for these reserves on the HOA side, you got a situation where a lot of HOAs may not have any reserves at all, or requirements for reserves, or they may be grossly underfunded. So anyway, that's just some stuff that's going on in some of the legislative stuff. Peter, do we? I know we got a lot of stuff going on. People going back to school and all those kind of things coming up here, so we'll continue to stay on top of stuff. But hopefully, we can do a little legislative update coming up too as well, and get some of that out there. But otherwise, we appreciate you joining us. We're here every Monday from 9 to 10 o'clock. Write down the number, 220-9788, 220-WSTU. So you'll have it. You can call in and ask questions, and we'll try to do the best we can right here on WSTU Digital 1450. We're Martin County's Heritage Station.